If you were spooked by huge market losses when the tech bubble popped in 2000, or with the mortgage crisis in 2008, or during the COVID-19 pandemic, you may be wondering if it even makes sense to invest in the stock market. With potential for such huge losses, isn't stock market investing just another form of gambling? You might as well just fly out to Vegas, put all your money on red, and just roll the dice, right? The answer to that question is a resounding no. In today's video, I'll show you 5 graphics that show you why assuming a long-term position in the stock market is one of the very best ways to build your wealth over time. A special thanks to Travis Gatzmeyer of Kinetics Financial Planning for the images. One of the main reasons people don't invest is because they're concerned that something will happen on the global stage that will cause their stock portfolio to plummet. Could be a recession or depression, a global war, or even a pandemic. The following graphic shows that there has rarely been a time in the history of our country where those types of worries haven't been present. Yet the stock market just keeps on growing. This chart demonstrates that the stock market is essentially a permanent upward trend with occasional bear markets 2 to 3 times on average every decade. If what you're concerned about is volatility, then the next chart should convince you that a long-term position in the market is the very best way to minimize volatility in your portfolio. Note that the best one-year return in the S&P is 47%, while the worst is negative 29%. Yet when you look at a 20-year rolling investment horizon, then the worst-case scenario is a positive 6%, while the best-case scenario is 17%. In other words, the longer you have to invest, the higher the likelihood that you won't lose money and you'll grow your assets over time. The next chart shows that if you fixate on 1 year of investing in the stock market, it can feel like gambling. Yet, if you zoom out to the 20-year view, you see nothing but growth. In other words, the more time you have in the market, the less it feels like gambling, and the more it feels like a relatively low-risk way of growing your retirement assets. Notice, lots of green and very little red when you take the 30,000-foot view to investing. In the next chart, you'll see that the longer you invest, the higher the odds of seeing investment success. Once again, this all comes down to your investment horizon. If you're only in the market for 1 day, let's say you're a day trader, then your odds are just over half that you'll get a positive return on your investment. If you're in the market for a year, your odds of getting a positive return in your portfolio rise to nearly 77%. However, if your investment horizon is 10 years, then there's almost a 97% chance that you'll experience a positive return in your portfolio. Not quite risk-free, but pretty darn close. In the next chart, we see that it's pretty much impossible to predict which asset class will give you the best return over time. So instead of simply investing in one asset class, say small cap stocks, the orange squares you see in the chart, you're much better off investing in the entire market. You simply don't know which sector is going to be the best bet in any given year. A properly allocated portfolio which invests in the entire market is represented by the white squares you see on the chart. You see that it's neither the best returning portfolio in any given year, nor the worst. This steady-as-she-goes strategy has proven to be a winner over time. It gives you your best shot at stable, robust growth over the arc of your investment journey. So the next time someone says don't invest in the market because it's like rolling the dice in Vegas, ask yourself how long you plan on being in the market. If you're planning on growing those assets for 10 years or longer, then volatility shouldn't be a barrier to stock market investing. By the way, just because you're in retirement doesn't mean you should stop taking risk with your money. If you can't grow your assets over the arc of a 30-year retirement, you dramatically increase the likelihood that you'll run out of money before you run out of life. If you want to learn more about how to make your money last in retirement, be sure to check out my tax-free toolkit. You can download it for free at taxfreetoolkit.com. If you're a financial professional and want to learn how to become a certified Power of Zero advisor, head over to powerzero.com and opt into my free 3-part video series. By the way, if you have any comments or questions, feel free to drop them into the comments section below. I respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.